Welcome in our market master today. Samir Arora is founder and fund manager at Helios Capital. He's with us. Samir, great to have you with us as always. Good morning. I want to start with exactly that, which is IT services. I mean, you know, you've had this pet peeve for a long time with IT and their acknowledgement or lack of acknowledgement of the disruption. Let's just start there. What you made of the earnings and go on. Yeah, please.
I think more than that. First big goof up is that not to invest in any new technology, helping others, do this. For example, if you've heard of a company called Zscaler, founded by two Indians, those Indians are worth combined husband, wife, some $18 billion. To see all this happening and to help others, but because of this fascination with cash flow and dividend yield and buyback. So, we are stock market guys and we like people who care about stock prices. But still, there has to be in not 1 year, 2 years, now 20 years have passed to not make $1 worth of investment in all these new technologies happening in front of you, not in front of us, but in front of them. To not do it is very disappointing. Second thing is, as I said, lack of acknowledgement, which actually distorts many careers. Because even today, if you keep saying everything is good and you don't openly discuss because next quarter price might be down, how many people are now learning coding when you know that the coding job will be 1/3, say half, whatever. 10 years later, 5 years later, you have to guide the world a little bit every day to only focus on what is to delay. I have delayed my hikes because this quarter margin will be lower, higher. I mean, this is overdoing. If you have to give it now, how does it matter that this quarter my margin will look 10 basis point lower, but next quarter I will save something on travel, so I will give a hike. I mean, this is just over catering to the market, which otherwise I like. But they are disappointing on many levels, philosophically and on a day-to-day basis.
You think at some point there will be a pivot and you will, as investors, I mean, at the end of the day, viewers want to know whether they, money can be made here.
Of course, I will do it and then I will come and confidently tell you why I like them at that point of time. But the point is today I don't and I haven't. And this issue is a bit serious. So this issue is, you can say, like the consumer staple guys. You are still the best companies, big companies, important for country, important for foreign exchange. It's just that your growth is gone. And when the growth is gone, you try and find all these bad, sort of in hindsight, you can call it, I don't care. But right now it is bad. So there is no point in saying that, now it's too late. It's not late, according to me. And we are not just telling you, you can see our portfolio, what we have and how much we have. And we also don't like, 3-4% kind of growth. Who cares for 3-4% kind of growth? If that is the case, then maybe the PE should be like HPCL or something 5. Then you might say, okay, doesn't matter. One day something will happen. But if you're already trading at these valuations, then you don't want 2 years of 5% growth because one day it might become 6 and surprise everybody. That's too boring.
Okay. IT is boring. But other than that, you like the market, you said.
I like the market. I have broadly liked the market. In between, there was this confusion that I had on this India-Pak war and all. But this time we realized that, these things get sorted. Unless they become very bad, then of course that is a low probability event. But generally, these things get sorted in 10, 15, 20 days. And then the rebound is at least half to 80% and move on. So I've been bullish on two things. For India, that is. One is that for last 6-8 months, not now, but say 2 months ago, from say September onward, there were big FII outflows driven by people feeling that they should go back to US. And so in September and January, there were very big sales of maybe more than 25 billion or so in 2 months. In these 2 months, not together. And then since April, May, it is clear that the world is not fascinated by US to the extent that they want to put back everything that they may have sold. And you can see that from flows into ex-US ETFs. There's a MSCI World ex-US ETF. There were articles on how many billions it has got suddenly. Even we in our global fund have reduced US weightage from 70% to 50%. And the world there are so many things you can read on that the world has slightly brought down their US, if not this much. For the first time in many years, the ex-US index is beating the US market. And therefore, if that happens, and there is a shift of 3-5% from the current US exposure of 70% to say 65%, 68%, that is massive money for the rest of the world. And in that, India has a strong case. India has a case in terms of inflation and interest rates and liquidity. And so even if we just don't get outflows, and plus the currency dollar is depreciated, so that's another reason why people don't like that much US. So if that happens, then just by not having outflows will be a big positive compared to what we have seen in recent 6-8 months.
So, Samir, you said that in your global fund, you've brought down the US exposure from 70 to 50%. Yeah. So, which other markets have you deployed that money into and how much?
So, we used to have this, by the way, fund went from 70 to near zero, fortunately in Feb. So, it has been brought back. So, what we've done is we used to have 5-7% in China, which we are now targeting, still haven't reached, but 15. So we are at 12 or so, and we did not have gold in that fund. I used to personally own gold, but in that fund now we have already bought 5% gold. And we are going to keep these forever now. I mean, ever means, let's see. And then the rest is in, we had these 8-9% in these two Indian ADRs all our life, which have not helped, particularly, you know which one. I hope one day it helps, which is HDFC Bank ADR. And the rest is rest of world, 20%. So 50, 15, 5, 10, and 20.
All right. Hi, Samir. Good to hear you this morning, and thanks a lot for joining in. Samir, what about, the Indian economy? How are you reading it? Because urban India still appears like it's very, very slow. If you look at, numbers coming out of Trent and the likes, which one would say is a little bit worrying. However, inflation has cooled off. And if I look at the nominal GDP, it's going to be sub 10% in all probability. So one way to look at it is the RBI is going to pump it up even more. We're going to get further rate cuts, which in turn could be the start of a fresh leg on the up move. How are you reading these data points that are coming in there?
So right now, if I look at it purely from earnings point of view, earnings are not great. As in this year, you can't grow more than 10% here or there because IT growing below 5 maybe. The large consumer companies growing 4-5%. The large banks or banks in general growing below 10 because of NIM compression and all that. But at least that one hopefully gets sorted out in 3-6 months. So for this year, whether we are positive because of flows, we are positive because of interest rates, we are positive because of SEBI and RBI being pro-market in some sense by reducing some regulation, putting in liquidity here, there. Still, you can't make obscene money, which would, according to us, be 20%. So you will make 10-12%. If you see now year to date, the market is up some 5-6%. So more or less, 0.8 to 1% per month if you get, that is enough. So that issue is there and you need a new cycle of something or some of these to do better. This negative overhang of IT is also actually going to over time feed into our consumer sector. So it's not straightforward, but 10-12% return is still reasonable to expect for some time. And they're hoping that some of these things, either because of pumping of liquidity or interest rate cuts or whatever, goes back to a little higher than they are now, and therefore the overall market growth is about 13-14%, which is sort of normal. Right now, it is below normal.
No, absolutely. I got that. By the way, Samir, there is, with regards to what the RBI wants to do, what we've been sort of hearing, picking up, and there was a RBI governor interview yesterday as well. I mean, they're very, and we've heard from the horse's mouth, but also generally feedback, people who go and give suggestions, etc. When RBI wants suggestions, I mean, it seems to be squarely focused on growth. I mean, asking banks, tell us what you need. And they're very focused on kickstarting another credit cycle.
Because we need it.
We need it. So
if
they are successful, even mildly successful, where will this show up in your way from an investment point of view? How do you connect it?
So as I said, first thing is that in financials, we expect that the growth rates will go back. That is in the banks and all. I'm still a little bit hesitant on our own sub-segment, which is capital markets, where again, we are getting carried away that every day the volumes have to go up and depository accounts have to go up and all that is, we are over pushing it. For example, I saw on Twitter somebody saying that BlackRock has some 12 trillion, therefore the asset management companies in India can grow forever. I mean, if this kind of wild connections are drawn, even though we ourselves own HDFC AMC and of course we own our own Helios AMC, but still we don't want to overdo these things. But before that, India as of now also seems to be a relative beneficiary of the US trade deal, because at least so far it has not happened. And if we finally get some 15% even, then all our competitors, China has 35 right now, 10 plus fentanyl, Vietnam has 20, Sri Lanka has more. Also, all these similar guys, Japan has 25. So even if we get below 20 anything, I hope we get 10, but let us say that looks a bit very optimistic right now. That also will be on the margin positive. So overall, it's okay. But in terms of the portfolio, we are still in the same old, which is financials and discretionary consumer a little bit. And then a few here and there you can see in different places, but no, because there are three big pockets: consumer, IT, financial. And if you don't have IT, that leaves a big gap. And therefore, you have to cover some other angles to spend that money or invest that money.
Samir, any new idea as an idea that you want to talk about?
No, we don't want to talk about, because
Talk as an idea that you
you
want
can
to
see them in the mutual fund disclosures and you can talk to the mutual fund manager or that team.
But I think the Flexi Cap Fund has made 4 additions in June. Siemens Energy India, Vishal Mega Mart, Niva Bupa Health Insurance, and Swiggy. So
I'm delighted to hear that you are reading your sister company's articles.
Yeah.
Control. You should have your own articles.
Oh, who told you that's not our article? That's our article.
I don't know. I also saw it today morning on Money.
No, Samir, you're wrong. We're reading our own content.
It's your own company, actually. Anyway, the point is, by the way, the Flexi Cap is doing very well. If you see it from, Jan was bad, but overall, if you do 1 year since inception, 1 month, 3 months, since February 1, it would basically massively beat the market. If you see it from inception, it would have beaten by more than 9% in less than 2 years, which is quite big and bigger than the biggest guys who are more in the news every day.
I got that. Do you think, one thing I've heard from many is insurance. I mean, again, we've spoken about financials, but insurance perhaps, in a way, does better and better. The last 2 years, again, like many others,
Correct.
Lots of regulation, lots of changes, but now it's settling in. We, of course, still are waiting for the new IRDAI chief, but there perhaps will be a little bit of a pivot, more friendly to industry, etc. Any thoughts?
So we have 3 actually now in all our funds. HDFC Life, and we bought this Nuva Bupa, and we also have ICICI Lombard. And the first reason was that they had done very badly. Like HDFC Life in the beginning, after a very successful IPO and all its returns being made in the first 2-3 months, I think, basically for 3-4 years, the stock market performance was ordinary to zero, and then the fundamentals caught up. And big picture is positive for this theme and this sector anyway. So if the theme is otherwise good, you just buy the obvious candidate also is enough sometimes. And these are the obvious candidates in this field.
And I think Bajaj Finance as well, you're topping up out there, right? That's
Bajaj Finance, we are topping up means actually that topping up is because that fund gets new flows.
Oh, okay.
But otherwise, all are buying. We all have it. Even I have it here. But the topping actually, in some sense, sometimes doesn't show. Sometimes doesn't show. We are very positive, very bullish. But what I'm saying is, every move in a mutual fund, you should take a little differently from, say, some other fund which has, sort of a more or less a regular size rather than like the mutual fund getting every month. Mutual fund is a good business, I must say. Every month the flows are very big and it is very heartening and pleasing to see that every day. But that also means that you don't interpret every stock trade as a new something.
Samir, quick word on gold, because that's, as you said, the recent addition, at least in the global front. You've had it personally. I mean, it's had such a phenomenal run. So it's very hard to make that argument that those kind of returns, or smart returns, will continue even in the future on that kind.
Actually, the thing is, this is the whole story which nobody knows. That the whole reason for being, not whole reason, but one of the reasons for being confused about US by the world is that the US debt is unsustainable. If you read this Ray Dalio book, Why Countries Go Broke. So all these things will lead you to believe that it is okay if you don't make much money on gold, but you don't want to have a situation where the currency in US goes a lot. Where Ray Dalio says that in 3 years, US will have a seizure plus minus 1 year, and he has written a whole book basically to lead to that conclusion. And we can see that the world, there is not enough of an alternative, as in if you don't like the US dollar, it's not that the world likes euro or the world likes yen, or they believe that those can take over. But gold is a neutral this thing, and it is, you can say, insurance, but also it's a hedge, you can call it, whatever you want to call it, to against the fact that the US goes bad. And, of course, recent days, the US market has done well. But every time these tariffs were increased and uncertainty was increased, and basically President Trump was very aggressive in criticizing other countries, for example, saying they are coming here to kiss my ass or something. So all these things would make you feel that these other countries will try, if they can, reduce, limit, but at least definitely not overly support the US Treasury.
You could have said, just kiss me.
So I'm saying, every time it looks to me that the word which was friend of US might say, now it is deal to deal, trade to trade, and just randomly putting everything in the US, if they have surpluses, all that is changing. Whether it is for fundamental reason or personality reason or, ego reasons of everybody.
Laughter in the morning, Samir. I mean, that's what the conversation with you always leads to. Lots of gyan, insights, but really some laughter as well, which all of us look forward to. Thank you very much for joining us. Great speaking with you, and appreciate your time here on CNBC TV18.